You may have heard one of the more popular sayings in the financial planning world: it's not what you earn, it's what you keep, right? So many people say that. And for many people, this past tax season was a painful reminder of that pearl of wisdom. We did see some nice gains, though, in the stock market in 2016. And for some, those gains created more taxes. It's no secret that one of the biggest drags on investment performance is taxes. And one question that we get a lot this time of year is, hey, next year, how can I reduce my tax bill? That's a great question, and here is a few suggestions for you. First, take advantage of asset location. We talk about this all the time. This means designing a tax-efficient investment strategy. This may be especially helpful when you have both personal and tax-deferred accounts. You should identify how tax-efficient each holding is inside those accounts and then act accordingly. So, tax-favored assets might be better placed in your personal account, where you could get potentially some capital gains tax treatment, while your less efficient assets may work better in your IRA. You don't want to turn capital gain taxes into ordinary income taxes if you can avoid it. Second, try to minimize or avoid any short-term capital gains. The reason? Short-term capital gains are taxed at the same rate as your ordinary income, which could be as high, right now at least, as 39.6%. Not to mention a potential extra 3.8% net investment income tax on high earners, along with, don't forget, state and local taxes. Ouch. If you hold assets for at least a year, the lower long-term capital gains rates apply, potentially taking a lot off your tax bill. So, if you can hold off selling at least until, you can hold it for a year, better rates will apply. You may be glad you did. Third, always look for opportunities to do some tax loss harvesting. And this strategy shouldn't be just reserved strictly for year-end tax planning. It might be a really good idea for you to work with your financial advisor at different points throughout the year to look for opportunities to harvest any losses you may have along the way. You can use those losses to offset all of your capital gains plus $3,000 of ordinary income. If you have losses, you may want to use them to your advantage and save on taxes. You've heard that nobody can control or predict the direction of the markets, interest rates, or economic conditions. Yep, that's true, but you can control how much you pay in taxes, the costs and fees, at least to some extent. You've got time now before the end of the year. Taking proactive steps right now could save you a lot of money come next April.